Hello, everyone. Welcome back to the Outspoken Market Global. Leandro Guerra speaking. And in today's class, I want to teach you how to calculate the supply and demand levels using Excel. Few weeks ago, I already discussed it with you guys and gave you the full idea behind this indicator that I have invented about 4 years ago, and the paper is available in the om-qs.com website in the blog section and will be here again in the first comment of this video. I have updated the paper back in September 2025 because I wanted to prove after several years that the idea of the indicator is still works and there was essentially no reason for this not to be working. And recently, if we want additional examples, we have here on the left-hand side, Microsoft stock 4 hours time frame, just to have more granularity. You will see that we nailed it once again with the indicator, right? In the monthly basis, that is the purple one, and the green one, that is the weekly. And now the minimum value that we have for Microsoft in June, it's precisely our indicator. And the same has happened with Bitcoin. When everybody was desperate after the fall from the 80 something down there to the 60, I told you guys, say, look, no worries, that will get back to the values because actually it hold there and went back to the levels once again. And we have tons of examples to, any kind of asset that you want. Since some of you may not know programming yet, but eventually one day you will, or essentially you just use Excel and you are fine with that. I'm also a fan of keep things simple. So this indicator, it's free to use as long as you mention the source. So I'm going to teach you that in Excel. It's easier from my perspective to do with programming, but in Excel it's not that complicated as well. You just need to pay attention. And here is the step-by-step tutorial. We have, and by the way, in the paper, we have the weekly and the monthly calculations. In the Excel, we will do for an intraday basis in the 4 hours time frame, right? So we have it here, essentially every candle every 4 hours. So you would have the calculation based on the projection from the past days, of course, or hours, and then doing this upfront. Again, I think it's nice to remember everything that you see in the indicator is ex ante. We don't do repainting. We don't use today information to predict it today. No, the levels are known beforehand. So if we are speaking about a weekly level, we will know it by the beginning of the week, and that will be valid for the entire week. And the same with the monthly one. We know in the first business day of the month, and the numbers are valid for everything that you have in the remaining days. The same idea will be here. So we will do the calculation in the close hour, my time zone. With forex, you need to pay attention to your time zone, but we will have that particular one done using that information wet in the close, and then the projection is done for the ones coming after that, right? For the candles or for the periods after that. So we know ex ante. It's fantastic. Now, I got this data set from my broker, and here in that Excel spreadsheet, we have two tabs. One, it's the data preparation, And the second one is the plotting of the supply and demand levels from the OM S&D, only with the columns that they are meaningful to us. What do you need to do? First, you need to calculate the returns, simple returns, just one day divided by the previous day minus one in percentage. And apologies, this is not day, this is a 4 hour time frame. So each 4 hours you have this. First thing, then, as an standard, and this is the suggestion I give to my indicator, use the rolling period of 20 days or 20 periods, whatever, for the volatility of the returns. So we calculated the returns period by period. Then we have here all zeros because we don't have enough data. But at this point, you have 20 previous returns. So you calculate the standard deviation. That's it. As simple as that. Then, since we have an information that will be got into the close and will be projected up, I mean, for the front periods, we need, in this case, to know the closing hour. So we have, in addition to the column that we have calculated the realized volatility, we have the column closing hour. That closing hour, you will do. I am on the Central European time zone. So to me, that particular market closes at 22 or at 23. It depends if we are in the summertime or not. So I do a very simple logic. If the hour I have in the date time column is or 22 or 23, it means I am or I have a closing hour. So I plot, or actually I write, I print a yes, a Y. In the other hand, if it's not, then it's a no, it's an N. And then I drag and drop to all the remaining cells. Great. Another column that we should be calculating, it's the supply level. So we have the first supply level. As per the paper, coming back to the formula, after calculating the volatility with a simplification in our case here for the Excel, but it still works, we have the example of the bands, right? That doesn't matter if they are annual or weekly bands or hourly, whatever. It's the idea of getting the reference price times 1 plus that realized volatility or that standard deviation that we did. And for the supply level, it's 1 plus that deviation, and the demand, it's 1 minus that deviation times, of course, the reference price. So you see, what we are doing is taking the volatility of the returns, then using it to project or to reflect that volatility into the price, and then make the price projection for the future. I'm not predicting the price. I'm just taking the information contained into the realized volatility to know where the market is going to stop. And it always stops there. Eventually, it may break in or out, but while it is in that number for the first time, there is a trade opportunity. And you will see this by yourself once you do the calculations and do the validation from everything that I'm doing, right? In our case, then, so we have the first supply. It is if we, right, have a closing hour, because I would just calculate this for the closing hours. So if the closing hour column is Y, is yes, then I have the time, I have, apologies, the price of that closing time times 1 plus that realized volatility. So you see, you will have plenty of zero cells because are the cells on which we have the no. But where you have the yes, you will have the calculation that is the closing price times 1 plus that is standard deviation, the realized volatility that we have. The second supply level, it's the same idea, but it's 2 times the realized volatility. The demand, that it's another column that we do the calculation, it's 1 minus for the first demand level and the 2 minus for the second demand level. And we have the skeleton, the main structure of our indicator already calculated. Now we prepare the columns that we are going to plot because we have the horizontal line on the deviations above, on the supply levels and the demand levels, and they are naturally an horizontal line, just shifting when we change the period, weekly, monthly, daily, whatever. So we need to ensure that information is kept is steady as we want to. And you see, Bitcoin at the time that we are speaking, it's visiting again. So we will have a rebound around this level. As well, you see Microsoft in the morning touched our level and it's holding up there. How do we do it? In Excel, we need then to understand, okay, have I had an information in the supply or in the demand columns? Yes, if I had, then I repeat that number forward. So the 1.2535 that we have here for the British pound against the US dollar, that was calculated here, we projected this for the remaining or for the following day. You see? And then again, here, that number, it's projected for the following trading day. And then you repeat. How do I do that in Excel? It's quite simple. I take the reference cell that I want to repeat, that is the supply level, and then I check and say, look, if my supply it's above zero, quite simple, then I get that number. Otherwise, I get the previous one. Because then what can I do? Here, I would check, is my supply above zero? No, it's not. But I cannot take then the zero. I need to take the previous number that I have used when it was yes. So it's a very simple trick, a very simple Excel trick. If you know maybe a more efficient way or a more intelligent way of doing that, leave me here in the comments, please. But to me, it's quite simple. It works. I'm an engineer. I'm happy with that. Simplicity works all the time. You see, this indicator itself is pretty simple. So simplicity works. Again, same idea. I am changing the day, the trading day, right? So I have identified that yes, I do have a number, then I take that number, otherwise I would take the previous one. And then I do this for the 4 levels, the 2 supply and the 2 demand levels. Since I have 4,000 data points that I will leave here for you, so you can do back testing, additional controls, audit, another idea, anything that you would like to check. Then, for the sake of our class, I took just the most recent data points. So starting in the 1st of April 2026. And then I have done this chart, this plot. So you can look that this is witchcraft. It's fantastic. The way it works in Excel, the visualization is pretty bad, but you will get the idea. So we have the four lines, the two ones in red, they are the supply zones, and the other ones in green are the demand zones. Every time that the British pound against the dollar goes to the levels, it bounces back. So you have a trade opportunity. There are cases on which the indicator fails. Naturally, nothing is perfect, like here, or yesterday in the Federal Reserve meeting announcement. But usually, as a best practice, these are the days that we avoid trading anyway. And now we are moving away from this, but you see that we are bouncing back. So here is the trading opportunity. So the idea that you can use this for taking your trading decision, it's similar to what you would do with the traditional drowning of lines of supply and demand levels, support and resistance, sorry. But we know that this is I mean, it makes no sense, right? The traditional one. Take a chart, identify, but it's bullshit. Sorry, pardon the French, but I mean, this, oh, Leandro, dear professor, it's too simple to be true. Simplicity works, my friends. We need to be humble. Simplicity works. Put aside the ego. Simplicity works. And this is quantitative finance, professor. Is it? Yes. Truly is. Ah, but I don't see integers, derivatives, and but or Markov chains. Who cares? Put aside the ego. Trade safe. Leave your comment if you have any additional doubts. Visit the blog into the OMS into the om-qs.com. So I will leave it here, right in the blog. By the way, daily I publish free the market notes on which I give to you as well the gamma exposure levels for the SPX, the triple Q, and for the Bitcoin as well, and the market summary. And you are more than welcome to visit us as well. Okay, leave your comment if you have any additional doubts, any additional considerations, or would like to see anything different or any other class, and will be my pleasure to help you. Take care, trade safe. Ciao, ciao.